just $1 million.
All right. Welcome to NCRAG for the evening. We are doing real estate investing partnerships or structuring partnerships tonight. This is part 1 of 2. So, surprise, we're doing the workshop tonight. Fooled all of you. Just kidding. I'm literally going to do that the next time we do partnerships. I'm just telling you now. It's just going to be random. We're going to have like partnerships 1, 2, 3, and 4, and one of them will be the workshop, and it will be just whatever night I decide. Yeah, on the spot. So, yes. So this is my soapbox for the night. Next week is the workshop. You don't have to come to tonight to come to next week. Next week is, in my opinion, more valuable. This is super valuable tonight. You'll learn how to structure partnerships. It will help you next week. But next week is where you actually get to practice in class, real-time live without the risk of losing money. So if you do it in class, and for those of you who have been to the workshop before, how many have been before to the workshop?
Whoa, just 2 of us?
Hands high. How many people have been before? Wow. Yeah, that's insane. Usually it's like half the class. So if you've never been, next week is the week not to miss. What's that?
3 times.
You've been 3 times? Denise has been 3 times. She's covering some other people.
Is it any good?
So did you get value out of it 3 different times?
Yeah, it's different.
Did you? Yeah. So it's different every time. Even if you came before, you should come again. But that's where you get to learn and you actually get to practice what you hear tonight in how to structure partnerships. And so you can go and do that on your first deal and potentially lose a lot of money. Or you can do it here in class and have no risk. The week after that, we will not have class. It's the Wednesday before Thanksgiving. Everybody should just spend time with their families or friends or whoever you want to spend time with on Thanksgiving. If you don't like your family, that's okay. Spend time with your friends, I guess. And then the week after that is Fire. James, are you going to be on Fire? It's not? That's what's coming, right?
Yeah, I just had to get the microphone.
Okay.
Yeah, it's going to be amazing, and I know I say that a lot of times, but this one I've actually been working on. I worked on quite a bit of it today. I've got a couple sons that have just entered the workplace, and both of them have an interest in achieving financial independence and retiring early. So this is like the class I'm teaching to my sons about how to achieve financial independence and retire early. And so we're going to go over safe withdrawal rates, how that kind of comes into play. We're going to go over like multiple ways to kind of achieve financial independence, retire early. I'll show you the actual numbers of how long it takes based on different savings rates, based on how many properties you buy. And I'll go over a ton of stuff. It is going to be one of the most amazing classes you've ever been to.
Except for this one and next week.
Yeah.
And then the Bare Naked Ladies are teaching the week after that. It's If I Had $1 Million. They will be here. So no one needs to talk about that because James already talked about it. You want to talk about it some more?
Yeah, just you basically suddenly come to $1 million, and I'll run a whole bunch of scenarios and show you how those perform.
Are we having a raffle and giving away $1 million or something?
We may. You have to come to find
You
out.
have to come to find out? Nice. No, the room is going to have like 2,000 people outside. We heard you were giving away $1 million tonight.
Maybe.
Yep, $100,000 a ticket. Introductions. So the question of the night, introduce yourself, and then the question of the night is, are you willing to do a partnership? And if you are or aren't, that's fine. Why or why not? And if you're not, why are you here? I guess. No, I'm kidding. How many people are new tonight? Like never been to NCRAG. So we got like a handful of new people. They don't get my sense of humor yet. It'll take like an hour and then you'll understand. So James, you want to start since you have the mic?
I'm James Orr, and I am willing to do partnerships. In fact, just yesterday I called up somebody about doing a partnership with me.
Who? Who was it?
I can't say, Brian, who it was. But yeah, I called up about doing a partnership. Had someone call that I'd seen their property before, and they were interested in selling now, and looks pretty interesting. We're seeing if they're willing to do our terms. So, yeah.
My name's Royce. I'm a long-term buy and hold investor here in Northern Colorado. I'm definitely willing to do partnerships. I've put a couple together. I think they're a great way to utilize different people's strengths.
My name's Barbie, and we are actually in some partnerships, so yes.
Yes. You can introduce yourself at least.
Sorry, I'm Bob.
The mic just flew right by. He's like, nope, not tonight.
I'm Denise, and yeah, I would be willing to try a partnership.
I'm Joe, and yes, I too would be willing to do partnerships.
Did you notice no one's answering why or why not?
My name's Casey, and I like partnerships because that way we can leverage other people's strengths.
Very good.
My name is Matt. I would entertain a partnership.
Somebody's got to say no, just so you know, just so I can put a mark on the
me.
no side.
I'm James. Absolutely. I'm married. We own 2 houses. That's partnerships, right? I love the idea of partnerships because there's a lot of things you can't achieve on your own that if you bring in the right people, you can do a ton of good things with.
I'm Lynn, and I have 2 lady friends that also have rentals, and we help each other out. And so now we're talking about forming a partnership.
Nice.
I'm Anne, and you bet ya, absolutely, because there's so many skills to learn. It's nearly impossible to learn them all at once on your own, and I know what I can do.
Are you from Minnesota,
No way.
Wisconsin, Canada?
No way. In Colorado since I was 5.
It's like, you betcha.
Hi, I'm Michelle, and yes, I would be willing to do a partnership. I think it's valuable to see other perspectives and have other people see possible blind spots that you may not be aware of.
If anyone here that's married says no, and their partner is here.
I'm Austin, and no.
I'm Tammy, and yes, and I agree with the gentleman down there who said that just to play off other people's strengths, so everyone can bring their own thing to the partnership.
I'm Jason, currently a Nomad investor. Next year, I will be looking to do 2 or 3 partnership deals because I view it as yet another form of leverage.
My name's Nick, and yes, I would absolutely entertain a partnership. Just like they've mentioned, I think when you get people who have different skill sets together, it combines to make a pretty good team, as long as you get the right pieces in there.
I'm Laura. Yes, I would definitely think about partnership for the same reasons.
What was the last part?
For the same reasons.
Oh, okay.
I'm Grace, and I would definitely entertain a partnership. I'm definitely not smart enough to do it all on my own, so it'd be fun to learn.
Hi, I'm Kelly, and yes, I would do a partnership for all the same reasons everybody else has said.
Sweet.
My name's Jim, and yes, I think that, being able to leverage other people's knowledge, my investment, time, there's 100 different reasons.
Hi, my name's Steve. Currently do small multifamily buy and hold, but I'd be definitely interested in a partnership for the ability to do larger projects that provide the capital and just the expertise that I don't have.
Yeah.
Hi, I'm Wade. I'm usually very definitive, but I'd have to say I'm probably willing. I don't know enough about it to really say yes, so
Perfect.
that's why I'm here.
Awesome.
I'm Mike. I am willing to do a partnership. I think that it's a good way to reduce risk, reduce the amount of time that it takes to own a property. I think having partners increases your accountability to work harder, and you can take down bigger deals and diversify into more properties.
Class is over. We're done.
Hi, my name is Emily, and I am willing to do a partnership. I have not done one yet. It's a little scary, the thought of, depending on other people, but I've met some really great people, especially here, which makes me feel more willing to explore the idea.
My name's Chris, and I'd never in a million years do a partnership.
I already marked you yes.
Just kidding. Yeah, I've done partnerships in the past, and I would definitely do them again. I think they're just a great way to scale and do more deals, and for all the other reasons people mentioned. So.
My name's Drayson. I would definitely do partnerships, and I have done them in the past.
I'm Colin.
we're doing some land development stuff and trying to grow faster. So of course we'd be looking to learn about partnerships to help scale.
Awesome.
I'm Kevin, and yes, I would consider one, particularly for the larger properties like multifamily and commercial.
I'm Dan. I've seen 3 businesses fail due to partners that couldn't get along. So if this is anything like business, these partners were pretty miserable. So I don't know. I wouldn't sign up for misery if I could do it. If I could do it and not be miserable and not fail, I guess I'd be up for it. But I don't know enough about it, I guess. That's bottom line.
No, it's fine.
Take the mic away. I'm kidding.
I've seen a lot of individual businesses fail too, so I mean, you can't just say.
Right. Yeah, I mean, what, like 80% of businesses fail in the first 5 years, and like or 90% in the first 5 years, and then in the next 5 years, like 9 out of those 10 that were left fail, something like that. So yeah. So I'm Brian Williams. For those of you who don't know me, I'm a long-term buy and hold investor in Northern Colorado. I invest in Fort Collins, Loveland, Evans, Greeley, Windsor, Severance. Used to be in Longmont, but not anymore. Not that Longmont's not great. Please don't take photos or videos or of anything of the slides or record audio, and please turn your phones on silent. That would be awesome. So just the normal disclaimer, because we're going to be talking about partnerships. I'm not an attorney still. I did not get my law degree yet. I probably won't. I'm not a CPA either. This is not legal or tax advice. Please consult your attorney and your CPA and your estate planner. Have them all talk to each other and talk to you before you execute on any partnerships, because that is part of how you structure great partnerships. So, what's the definition of a partnership? More than one person. What else? Marriage without what? Without the lovin'? Marriage without the lovin'. I like it. Yep. What else?
Formed for the purpose of making a profit.
Formed to make a profit. What else? Anything else? All right. So it's the state of being a partner, right? Just got to go with the just dumb definition first. Second definition, right? A legal relation existing between 2 or more persons contractually associated as joint principals in a business. Seems reasonable. A relationship resembling basically this, right? Usually involving close cooperation and joint rights and responsibilities. So, partner, what's the definition of a partner? Typical definition, someone's husband or wife, right? You look it up, that's what it says. Second definition, one of 2 or more people, businesses that work together or do business together, right? And so what do we have? A partnership looks a whole lot like marriage, right? Would you get into a partnership with somebody that you had just met at NCRAG for the first time and be like, hey, yeah, let's go do a partnership? Would you marry someone that you just met at NCRAG? Probably not, right? So this is like, I would really encourage you to take that seriously. Like, you're, in a sense, getting into bed with people that you're going to be a partner with for some period of time, right? Yep. It is a metaphor, James, and you have the mic, so if you're going to talk, could you please speak into the mic? I mean, you think you know this by now. It's also not going to amplify your voice, in case you're wondering.
Okay, fair enough.
So you saw the first one. Some of you guys named these, but why would you want to partner? Like, what is the benefit? So I mean, I left the first one up there. So resources is one. What were some of the other reasons you guys have for why you might want to partner with somebody?
Shared burden.
Shared burden. Knowledge. Experience. Accountability. That's a big one.
Shared misery.
Shared misery. Anger. Disappointment. Yes. Class is taking a weird turn. So division of work, right? One of the things is, oh, I'm too busy to do this all by myself. I would really like some partners to share this burden of work with me, right? Seems logical. Sharing the risk, right? Do you want to go buy a 100-unit building yourself if it's your first investment? Probably not. I mean, it'd be very difficult to anyway. But even just buying, you know, a small multifamily apartment. Like if you've never done it before, but you've got money, you're like, hey, I'm really interested, I've learned everything I need to know. Great, share the risk. Multiple sets of eyes, right? You're doing your analysis, you're like, I think this is a great deal, and then you take it to James and he goes, this deal sucks, right? And then you get to have the debate about why each one of you thinks that. So that extra brain or 2 brains or 3 brains looking at the same numbers are gonna help you. Larger network of people. How many people does James know? Like 4 million, right? How many people do I know? Less than 4 million, by a lot, right? So by knowing James, my network expands, right? If I'm like, hey, I don't have this person, I can call James, he'd be like, I know 2 or 3 people that could do that. And then I can call them and see if it's a fit. Different strengths and weaknesses. This is always the one that when people are like, why do you and James partner? You like basically have the same strengths and the same weaknesses. You guys shouldn't partner together, yet seems to work out. So hopefully when you partner, you're finding someone to offset your weaknesses, right? If you're really bad at deal analysis and you find someone else that's really bad at deal analysis, probably not really a match made in heaven for buying deals. Confidence and motivation. How many of you guys have gone out and bought a property and then you're like sitting by yourself at your computer looking at the numbers and you're just like, oh, I'm totally not motivated to deal with this crap today. I'm gonna go outside, I'm gonna go for a walk, right? Having a partner who you know, hey, we have a meeting on Tuesday at 9, I have to have my stuff, right? That helps you stay accountable, to Royce's point, and stay motivated. And be accountable. Well done, Royce. Got the last bullet on the slide. Must be the most important. So tonight I'm going to kind of go through kind of the beginnings of a partnership and then really dive into how partnerships might work, talk about some of the operating agreement points, and then talk about a whole bunch of other stuff that we can't really fit all in one class at the end. So in order to make partnerships successful, right, if you begin with the end in mind, that will definitely help you. If you're thinking, where do we want to end up? Versus, hey, let's just go buy this deal. It's a great deal on a house. Let's go buy it. If you're not thinking about what is my exit strategy, how am I going to actually deal with this, and what is the longer term plan, it's probably not going to go well. Common objectives. If you aren't on the same page with your partners, right, whether it's a partnership in real estate or a partnership in marriage, what's going to happen?
Blow up.
Blow up, yes. Exactly. I mean, if you're like, hey, I think our objectives are here, and James is like, I think they're over here, and you're partnered, it's going to be really tough to get on the same page. You want to have this stuff done and set up front. Some of this seems really obvious, right? It's like, oh, of course you would do that. No, of course, most people don't do that, right? This is why, you know, Dan has seen businesses fail with all of the misery. It's because probably they didn't sit down and go, what are our actual goals? Where do we want to be? So with that, right, addressing what the expectations are up front. And I will tell you that some of the expectations that people have, they never get stated. And so they're just assumed. Well, I assumed you would do that, James. Like, you know, why don't you have that done? And James is like, well, I assumed you would do it, right? Talking about that stuff and addressing who's doing what, right? The roles and responsibilities, but what are my expectations of James and what are his of me if we're in a partnership? James.
And part of that, for those that haven't done a lot of partnerships, is knowing what all of the things that need to be done in the partnership. And I think you have slides on that later on that you're going to go into detail to help people.
I think so. And so as a part of my intro, like I'd have to count them, but I run several partnerships. I've formed several partnerships. So this isn't just me like talking about it. This is years of experience of doing it. Handle disagreements before they come big. That thing where I'm like, you guys have certainly felt this. You're like frustrated with your partner in life, and you're just like, you don't say anything, and then it just, and it grows on you and grows on you and grows, and finally you're just like, you explode, right? And you blow up, right? That feeling, that will happen in partnerships in real estate as well. So if you're feeling that way, say it early. Handle that disagreement. Write down your agreement. It's a step that seems, again, really obvious, but if you don't do it, man, it's going to be tough to know, hey, what did we decide about that when we entered this partnership? Have a risk disclosure. If you're partnering with people that are outside of kind of the real estate kind of world, you're partnering with someone in your family or a friend who's like, oh, I know you do real estate and you're telling me you got a 30% return on this property last year. I really want to be involved. And then you bring a deal to them and you're like, yeah, it's basically the same, right? Only it's not, because it's a different property and it's a different point in time. if you don't give them a risk disclosure that basically says, hey, you could lose everything, you really could, right? Then you're probably not doing the right thing. You want to explain, these are the actual risks, this is the worst case, this is the best case, and this is what we're hoping for in the middle, right? I'll talk more about how to present to, when you're presenting to someone like that, there's kind of the, I'm presenting it to get the partner, and I'm presenting it to actually just decide whether the deal is right or not, right? In my opinion, presenting it just to find a partner isn't the right stage ever. Utilize the strengths of the partners. If James is good at making graphs, I'm not making graphs. James is really good at making graphs. I don't like making graphs. Define the roles. Have accountabilities tied to those roles. This is what you're going to do. This is by when you're going to do it, right? Setting all this stuff up early will help you be successful. Be fair. James, should you be fair? Yes. Nice. Good answer. So I think a lot of times these small disagreements that come up, right, being fair in those will really help either build or tear down your partnership. It's like, how important is this, right? Do you really need to have the red tile versus the beige tile? Like, who cares, right? Is it going to make an impact? If not, move on, right? Have a discussion, move on. And if it's a two-person partnership, we've talked about this in a previous class, if James is really stuck on one side and I'm really stuck on the other, how do we decide? It's 50-50. Who wins? Rock, paper, scissors. Yeah, I mean, really, how do you win? Yeah, the silence is a good answer, right? Yeah, so you find an arbitrator and you still can't agree. Yeah, eventually you're going to court, right? Which sucks. And so, are you guys 50-50 partners? No. Oh, well, hopefully there's a third. The third guy can like side with one of you, right? But this is the downside to 50-50 partners, right? Is that when you run into that, it's really hard to decide. And if you're a 51-49, you're like, hey, James, I'm letting you in the deal, but I'm only going to give you 49, and then every decision is mine, that's crazy. So I run a partnership where I am more than a 50% partner, and there are several other partners. And even though I could make every decision without consulting them, I don't. I don't ever do that, right? Like, I ask, hey, what should we do as a collective whole? Because otherwise, I'm going to damage the relationships. I'm not going to be communicating well, right? So be fair.
Yeah, every partnership is sort of like an interview for future partnerships and future deals. So if you kind of think about it that way, you want to be a good partner that people are going to want to do additional partnerships with in the future, in my opinion.
Yeah, you just want me to say James is the easiest partner you'll ever have.
It is true.
Maybe. You were kind of difficult for 2 weeks when we were deciding all that stuff. Talk into the mic if you're going to talk. I mean, come on. So, leading to the next point, under promise and over deliver. So if you're like, hey, I looked at this deal, I feel like I'm going to get 12% return for my partners, right? And the downside is I'm only going to get 4, and the upside is I might get 16. If you promise them 12 and you give them 10, are they happy? No, they're not. They're like, you told me I was getting 12. If you tell them they're getting 5 and they get 10, are they happy? They're ecstatic, right? And we're going to talk about kind of what the returns might be for people that aren't involved in real estate. Communicate regularly, which sometimes daily may actually not be enough. Depending on your partners, depending on what's going on in your deal, when you're in that buying stage and there's just tons and tons of stuff going on and you need everybody to be doing their part, daily communication may not be enough. Honor your commitments. This is kind of what James just alluded to. Your partnership now is essentially an interview for you to do partnerships later. So there are people in this room that are partnered with me on stuff. If they were like, Brian is a shitty partner, would I be standing up here? Probably not, right? They'd be like, man, that guy teaching the class tonight, he's not a very good partner, and this is why. So honor those commitments because it's a small community. I think anywhere you go, your reputation really depends on it. If you constantly are just screwing over partners or not acting appropriately, it's going to come back to bite you. How do you find partners? Here. Not rhetorical. Here. Jason says, here. How else? How do you find your partners? Your friends. Go to the bar? Do you go to the bar and find partners? Sure. I've never found a partner at a bar that I did a real estate deal with ever. So here, friends. Who else? Who else can you partner with? Family. Business people. Rich people. Right? If you have rich friends, rich uncles. So friends and family, definitely at the top of the list. What if you lose their money? It's a common thought. Hey, mom, this is mom's retirement I'm playing with. Do I want to play with that money? Well, hopefully you've discussed with her the risks in your risk disclosure, and you've talked about it. Would you guys raise your hand if you would work with friends and family?
Could you raise friends?
Huh?
Like friends, yeah.
All right, we need a separate question. Raise your hands if you would work with family. Raise your hands if you would work with friends. Now these guys feel okay. It's a good thing we don't have a video, right, for your family. I won't mention your name. Look around the room and introduce yourself, right? Here is one of the main ways you can find partners. However, the downside to finding partners here in some sense is that a lot of people here have a lot of real estate knowledge. So if you're like, man, I need to get 75% of this deal, it's probably not going to happen in this room, right? Because people are like, well, why are you getting 75%? I'm, putting in all the money. And that's what next week is really about. Acquaintances. So you're at work and you kind of constantly talk about, hey, I did this real estate deal. I bought a house last week. This is what I think it's going to make. People overhear that. People start asking questions. And then maybe that leads to something down the road. Networking is super important. I'm just going to say there are SEC regulations that you don't want to mess with. So if you are doing a much larger deal size and you have lots of investors or there's super high risk tolerance, please consult a SEC attorney who can help you either with Form D or a private placement memorandum, as opposed to just saying, oh, I'm going to partner with everyone in this room on a really high risk deal that's worth $10 million. The SEC will find you. Any questions on that? Perfect. Question? No? So what entity should you use? So asset protection, which we're not teaching again for years. If you're a client of James's, you can listen to it. Most of the time, you're probably going to be using a limited liability company, which is an LLC. We cover this in very, very deep context in the asset protection class, so I'm not going to touch on it. There are partnerships that get done in general partnerships, limited partnerships, limited liability, limited partnerships, and asset protection has kind of all of what these different entities, the benefits, the pros and the cons are for using these entities. For tonight, we're really going to talk about just kind of LLC partnerships, very simple partnerships, because once you understand how to do those, you could scale up as needed. So simple partnership is, hey, I'm going to go form an LLC, and James and Royce and I are going to partner. We're going to be members. We decide that James is going to go find the deal, Royce is going to sign on the loan, and I'm going to bring the money. And we go form one LLC, and then we go buy one property. Fairly simple, right? From that point of view. However, you could make this very complex. And this structure is a structure that James and I set up a long time ago, where our intent was James and I were partnered together on everything, and we were going to have other partners that came and joined us in different fashion. So in one case, I'm just going to put the whole slide up. Here's James and I. See, I told you it was going to get complex. This is James and I, right? But in this case, we needed a money partner. We went out, we're like, hey, we can sign on the loan, but we actually want to have a money partner. So we would find person A to be a money partner, and our master LLC would then partner with that person. In the second case, we actually wanted to find a loan partner and a money partner, and we would bring the deal, and so our LLC would partner with two different people, person B and person C. And then in some other case, we find another partner who has the capability of both signing on a loan and bringing the money, so our LLC would partner with that person D, and we'd go buy properties as needed underneath those LLCs. So super complex way of doing it. We could have also started an LLC as an S-Corp for property management as well. Any questions on this super complex slide? It's not super important for tonight. It just shows you that partnerships can get complex depending on what you're trying to do. Silence. All right, time for a discussion. What kind of return and why do you think partners want or expect in a real estate deal?
I think all partners want infinite return.
Nice, thanks. Yeah, I know. This is your turn.
Predictable.
Predictable return. Interesting. How much is predictable, though? What kind of returns do you think your partners want?
Depends on the risk exposure.
And how
Sure.
much they're working at it too. If they're just a money partner.
Sure. So if you're a money partner, what are you expecting as a return on your money? What do you think your partners expect?
I better get at least 8.
Excellent. How much money do you have? I will take it. I will partner with you.
I was going to say 20 minimum.
Right. So how much, if you go and partner with your best friend who's not in real estate, what are they expecting as a return?
Another question to ask is, what are people getting on returns and other investments?
Sure. What's a savings account get you today?
1, maybe 2.
Yeah, the limit as it goes to 0, right? So what would your best friend expect? You call him or her up and say, hey, got a real estate deal. I need you to give me $70,000 for down payment. What do they expect on their money?
Of course, it depends sometimes on the amount of money invested. So we typically like to use kind of a sliding scale, starting at 8 to 10% for our money investors strictly.
Okay.
And when you say it depends on the amount of money, the more they loan you, the lower the rate?
It would depend on their position, their lien position. First lien is more secure, obviously.
Sure.
Second position is a higher risk, so higher interest.
Sure. So 8 to 10%. Anybody think higher or lower? You said 20, James. Jason, what do you think?
Wait for the mic.
Wait for the mic.
I think it depends heavily on the financial sophistication of the person that you're partnering with. I do a lot of work with CPAs and lawyers. They are financially sophisticated people. They're going to expect closer to 14, 18 a lot of times, I think.
Okay.
I think part of it depends on what part of their bucket they're investing. If they're
Sure.
investing their safe part of their portfolio, or if they're investing their higher risk, higher return
Yeah.
portfolio.
So who else has a number? If you go to your best friend and you just think, hey, I need to borrow some money from you, what are they going to loan it to you at? What do you think is reasonable?
I could totally get my best friend to do it for like 4 or 5%.
Right. So if you take a deal to your best friend who's not in real estate and you say, I've got this deal, the return is 18%. What is their response?
It's unbelievable. Like, not believable.
Yeah, it's like, no, that's crap. There's no way you're going to get 18% return, right? How many of you have got an 18% return or higher in real estate in this room? Right? Hopefully, if you're doing deals, you're getting higher than 18%. So if you tell them it's 18%, they're going to balk at it. A lot of people are exactly this. Wait, I'm getting 1% in my savings account, and you can give me 5, 6, maybe 7, right? That's a huge win for them. That's like a 700% increase over what they were getting. And if you have a really great relationship with that person, then they probably feel a lot more secure. Now, should you take advantage of that? Absolutely not, right? This isn't just go use all your friends' money at 6% and buy everything you can and then have half your deals go south. This is, you need to be really on top of it. But I think the point here is if you come in with, hey, I can get you 12%, even that seems unreasonable. If I told my mom I could get her a 12% return, she would just laugh because she's like, there's no way, right? The highest return that she's probably seen is like in a CD, and it's like 8.25% in 1985 when, you were getting 8% on your savings account. So be cautious when you do this. You don't necessarily need to give 12% or 18%. You can get, hey, can I borrow the money for this at 5 or 6%? Make your customer happy, much like when you go on a seller presentation to buy a house, you're not, hey, I'm going to give you top dollar. You're going to solve a problem for them. So if what you're offering solves a problem for your friend or your family member, I think that's fine as long as you're disclosing the risk.
Yeah, and there are some investors, and you could choose whether or not to accept this, but they will go out there and ask people what they'd like to get for their return. And if the return is lower than what they're paying right now to someone else, they may actually replace the money and take the money at 4% or 5% and replace 6% money or 7% money, pay off the 7% money, and replace it with the 4 or 5 if that's the case.
Yep.
And if someone comes in and says, hey, listen, I need to get 12% of my money, and you just tell them, you know, right now I don't have any use for 12% money. The lower interest rate you give me, the more likely I'm going to use it right away. But if I get down to the bottom and I don't have money and the deal comes up where 12% can be supported, I will use that 12%.
Yep.
And so it's a race to the bottom if you're in a position of abundance versus scarcity.
Yeah, and this is why that networking comes into play, right? If you have 6 different people that you can go to and you're like, hey, I've got a deal. I know you're at 6%. I know Royce is at 5.5%. And Tammy's like, I'm going to undercut James. I'm going to be at 4.5%. Right? I'm going to call Tammy first. Hey, do you have the money for this? Right? I'm going to work my way up that chain. So think about that, because going and saying, hey, I'm going to give you 18% is overwhelmingly, and it's unbelievable. Right? It's not like it's unbelievable in a good way. It's just not actually a plausible belief in their mind.
Yeah, and so I think we talk about the different interest rates too, and it may be length of partnership, how long money is actually placed, because if they're getting they might get a higher interest rate, but maybe their money's not placed all the time. All of that is plays into really what they're looking for.
Right. So, you know, you talk to private money lenders or hard money lenders that are willing to do longer terms. You know, it might be 12% for a 6 to 9 month loan, but if you're taking their money for 3 years, you might get 8 or 7%, or even 6%, right? Or lower. Right? If they're like, hey, will you just hold this money for 5 years? I will totally give you a lower rate, because then I don't have to deal with the hassle of somebody coming back in, the money turning over, it not being placed, me not making money during the time it's not placed. James.
And the reason I asked Casey the term of the loan is that sometimes if you have a large amount of money to place, you are willing to accept lower so that you can actually have the money out working if it's otherwise just not getting a return somewhere. And so sometimes you're willing to accept less with larger amounts of money than you are with smaller amounts.
Yeah, no doubt. All right, examples of how to partner. So up front, I'm just going to say, when you're partnering, always disclose all of your plans to your lender. You know, you could go in and be like, hey, I've got down payment, but really you're getting it from a friend, you're borrowing it. Talk to your lender about this stuff, right? They should know what's going on. Talk to your partners, talk to your attorney, talk to your CPA. Make sure it's all on the up and up before you move forward. So you could partner with yourself. It's a place to start, right? Hopefully you are trusting of yourself and you're willing to partner with yourself. You can do this by buying a property in an LLC. You can use your own money, or you can take a personal loan. Hey, mom, I need a loan. Can you lend me some money, right? If your mom really likes you, it might be unsecured. That's super risky for my mom, right? It's not secured by a property. So do you want to put your partner in that position? These are things you need to think about. Liability is obviously with you, regardless of the outcome. So it's not attached to just the property in the LLC. If you're personally signing, you're personally liable. Have the LLC take the loan instead, right? Very, very simple. In this case, you're probably securing it with a promissory note and a deed of trust. So if my mom loans me some money, I basically give her a lien on the property, and now she's at least secured by the property. If I've already 100% financed the property, and then my mom loans me some money and she's the 20% above the 100%, is she in a safe position? No. We got a quiet audience. Is she in a safe position? No. Okay. Quiet class tonight.
She might be in a safe position.
Yeah, I mean, it depends, right? If she knows, hey, if things go south, I'm still going to make it right. But what if everything goes south, right? There's always a point where there's probably some risk there.
And what if you're buying at a huge discount? What if you're buying at 50% of value?
Yeah, I'm talking 100% loan to value.
Yeah.
And in this case, the liability ends with the loan guarantor. So if just the LLC signs on it, then the liability ends with just the LLC. If you personally signed on that loan as well, then it ends with you. Obviously, if you're negligent, none of this applies because it's going to be overruled in the court. And remember, this is key, right? It's a loan, so even when there's not enough profit, you still need to pay it back. It's like a mortgage from a just normal lender. It's like, oh, I don't have a tenant, I'm not paying my loan this month. It doesn't work, right? Just because it's a partner. So that's kind of the simple way. And then this is really focused on where we're going to go next week, which is kind of the 3 common partnership roles that are kind of at the basics and the beginnings. There's a loan partner. So a loan partner is someone who is able to get a loan from a bank. They're not bringing their own money. They're actually able to go to closing. They have a high enough credit score to qualify for a loan. They have a good debt to income ratio. They can get that loan and they can go and they can sign on the loan paperwork at closing. Money partner. This is easy. It's the person that's bringing the money, right? What are they bringing the money for? It's probably not just down payment. What other money are you going to need initially to start a partnership? Startup costs, down payment,
Reserves.
reserves, right? Don't forget about reserves. And then you've got a deal finder, right? And these people may be all the same, right? Because you could look at this and go, yeah, I went and found my own deal, and I signed on my loan, and I brought the money. Yep, you did all three. But in some cases, this may be the same person, and this may be one different person, right? There's a way to mix this, and there's tons and tons of different ways that it actually works. So the deal finder in our case, and for our class next week, this is the person that has the deal. So James, like doing some marketing, gets a call, finds a deal, says, oh, I don't have the money or the ability to sign on a loan, so I'm going to go find a money and a loan partner. He says, Royce, can you supply the money? Royce says, yeah, but I can't sign on the loan. He says, hey, call Brian. Maybe he can sign on the loan. Brian, can you sign on the loan? Yep. Excellent. Now we've formed a partnership and we can go get that deal done. So here's some examples, right? Using those three. You bring the deal and sign on the loan, and you partner with somebody who brings the money. You bring the deal and the down payment, so you're the deal finder and the money partner, and you go partner with a loan guarantor, someone who can sign on that loan. You bring the deal, and you go find a partner or partners who brings the down payment and signs on the loan. You bring the deal, some of the money, co-sign on the loan. It doesn't have to be like, oh, I'm only in this role, right? You could be in multiple roles on the same deal. And then find someone else who can co-sign on the loan with you, brings part of the money as well. Figure out how to partner in that way. So anytime you see the word partner, it could obviously be multiple people, right? If you need $2 million to go buy a 50-unit apartment complex, it doesn't have to be one partner that's the money partner. Make sense? Mike, back there. To Nick, not to Mike.
Do any of these carry more weight as far as what they get percentage-wise, or is that how it's worked out?
Hey, how much? Where's my wallet? I have to pay him for that lead-in. So, if you're going to partner as a loan partner, I'm going to get right to that in the next 6 slides. So, the loan partner is a loan guarantor. We covered this. If the loan isn't repaid, this is the person that's liable. They've personally signed on the loan. So, everything goes south. The bank is coming to this person to make it right. Their credit is the credit that is at risk. So you don't make the mortgage payment, whose credit drops? This person. How important is your credit to you as a real estate investor? Mine's super important to me, right? I mean, James is like, meh, whatever. Taking the loan, just taking the loan and signing on the paper will probably drop your credit by 20 to 40 points, and it'll take about 3 months and it'll come back up. Right? It's just, hey, you've initiated new credit, and go from there. Typically borrowing 70 to 80% of what's needed, right? Standard stuff. I'm just trying to make this really easy so that everybody understands what the role is, right? Does this count as bringing 80% of the money?
Yes.
James is like, I'm a loan partner. Yes, it does, right? It's really interesting. Hey, I'm bringing 80% of the funds for you to close this deal. Should I get 80% of the profits?
Yes.
James, turn the mic off. Royce, take that mic away from James. They also bring the loan terms, right? So everyone in this room, if we all went to the same bank on the same day, many of us would have different interest rates and different loan terms available to us based on our credit score and our debt to income ratio. Some of us would not even be able to qualify. Others would be able to qualify for great loans. Some programs may actually be in effect that aren't available for other people. He's got his name tag, don't worry. Covered that. Other partners, right? Not the loan partner. Other partners are responsible for bringing the deal, down payment, capital expenditures, upfront stuff that you need cost-wise, reserves, capital calls. Hey, we don't have enough money, we need more money. So that's how we're defining loan partner for this kind of narrow definition for tonight and for next week. Any questions on loan partner and their role? All right, now we get to have fun. Now we get to ask, what?
Who's willing to be a loan partner?
Now we get to ask Nick's favorite question. What is that worth? So if there's 100% of a deal to be divvied up, how much should the loan partner get? Ready, begin. This is the class participation part where
Who has
you
an
guys
answer?
get to name numbers. How much is that worth? Put yourself in the role. I'm going to sign on the loan paperwork at closing. I'm going to put my credit at risk. I'm bringing 80% of the funds to buy a single family home and partner with somebody who brought the deal and brought the down payment. How much of the deal should you get?
What's the house worth?
Doesn't matter. It's a percentage.
So the answer to most of these questions would be it depends. It depends on all the variables that go into it. It depends on.
Yep. But in general,
the
what do you
larger
think
the
that's
deal.
worth? Single family home in Fort Collins. Who cares? $200,000, $300,000 home. It's a percentage.
35 to 50%.
35 to 50%. Higher or lower? Bob, hang on.
Wait for the
hang
mic.
on.
Wait for the mic. Wait for the mic.
Hang on. Hang on.
You gotta get this on recording.
So the money guy, if
This
the deal
is the
goes,
loan partner.
I know, but I'm
Okay.
just going to talk about it for a second. The money guy, if the deal goes south, the money guy loses his money.
That's
So
2
it's-
slides away,
it's
Bob.
20%. So he loses 20%. This guy,
Yes.
if the deal goes south, he's got to pony up 80%.
Does he?
Well, he's got to make good
He also
on the
has
loan.
the house, right?
He does have the house. That is right.
So he's got collateral. The bank says, hey, the market goes down, the money partner loses their 20%, but it's still worth the 80%. He can just give it back to the bank. Hey, I'm even. What's the risk?
It's a house in Detroit, and
okay, we're in Fort Collins.
okay.
But
my opinion was the guy that he has most of the risk, in my opinion. So he should probably walk away from.
you think the loan partner has most of the risk?
I do. I think he has most of the risk, so he should reap most of the reward. That's my take.
Awesome. I know what role you're in next week.
And I'll say that I don't think the loan partner has near the risk that the money partner has. And so for me, it's worth a lot less than 30% of the deal. In most cases, I guess if there's like a really weird deal where that financing is, that's the one thing it's keyed on, that's probably it. But general single family home stuff, it's probably a dollar amount.
All right.
He's gonna be a loan partner for me.
Royce is? You're also a loan partner next week.
I would say my gut reaction would be like around 20%, but be able to go up or down slightly from that based off the type of loan they qualify for. If they're getting a really good interest rate, you know, then maybe they should share some in that profit, but around there.
Anybody think higher than 50? Yeah.
No, I'll just say
Sure.
that he's leveraged. He doesn't have risk. He has a moment where everything goes to heck, and he has to turn around and find another deal, like people
He's got
to
all
cover him.
this risk, right?
Right, but he's leveraged to 80% of that property value. And so if everything goes sideways, he only has to cover 80% of the property value. Like he doesn't have to,
Which is only $240,000 on a $300,000 house.
but he doesn't have to come up with 100% tomorrow. He needs to find somebody.
He needs to be able to pay the mortgage
He
payment,
needs to be able to pay the mortgage
right?
payment.
That's
so,
what really the
so
thing
he's-
is, until it gets better or
until it gets better, or
he goes bankrupt.
he hopefully has money backing him, right?
But that's not the loan partner's role.
That's true.
Yeah.
Right. I guess why do you have this loan partner if he can't cover it if things go sideways?
The loan
That's
partner
my
is
question.
bringing the loan from the bank, right? The money partner is bringing the money. If you need more money, in the way we're defining it very narrowly for right now, the money partner should have that money, right? And so how much risk is there? I mean, we're going to obviously get to the money partner, but when you think about the loan partner, guess what you get to do as a loan partner? Send in a loan application, get approved, go to closing, and sign your name a bunch of times. It's not very hard. No, I mean, you don't have to come with money later in most cases, right?
What's the return
So-
on investment for the loan partner, Brian?
What's the return on investment? I don't know. How much do you pay yourself an hour for, or how much is your time worth for signing on those closing documents, right?
A lot.
Because your investment is just time, right?
Credit
You're not
score.
investing money, but you're investing your credit, your time, and your ability to get the loan. We got questions back there. Just start there. We'll work our way across.
So I think it sounds like most people are in agreement it should be tied to the level of risk that this partner's taking on. And that seems to be something that you could tweak depending on the terms of the partnership and what your what you're going to do in X or Y event. So if there's a market downturn, is there a commitment to cover those additional costs that maybe aren't coming in through revenue, or just how it feels like all of that can.
So let's
kind of
say
be
all that
adjusted.
extra cost is the money partner's role.
Right.
Right? Like, what is the risk that the loan partner has? And what's that worth? Right? And the struggle that you're having is the struggle that's real, right? And that's why we do this. Because it's not like, oh, yes, it's 24%, right? And that's the number. Because it's not. It's going to depend on your partner, right? It's going to depend on the deal, right? It's obviously going to depend on a lot of things. But how many people think this is worth 80% of the deal?
I do.
Other than James, who's just being facetious in a weird way, we're not even going to cover what he's talking about tonight. So, no one raised their hand. How many could see it being worth 60%? How many could see it being worth 50?
You would say number of hands for the mic.
So there was 1 or 2 for 60. There's 5 for 50. How many could see 40? Maybe 10 hands. How many could see a third of the deal? Yeah, because it's easy, right? There's 3 people, a third each, right? You're like, that's a simple way to split it up. Let's go, right? It might be, but it might not be. There's this is just it. If you're trying, someone comes to you, you have 2 people come to you, and I'm the deal finder and Royce is the loan partner, and we're we each want a third. You can have a third too. Do you want to do the deal? Maybe you do, right? Maybe you don't. So, Jason.
For me, it starts at 50% and I'll go down from there, but I'm going to start at 50 in my head because of the opportunity cost. Is there already grabbing for the mic? To me, because I can only sign a certain number of loans given my income and everything. So if I sign for this deal, that means I can't do, maybe I can't do a Nomad property this year.
Right. Yep. And so they're opportunistic trade-offs. Michelle had a comment.
Yeah, he should be set up for next week.
Yeah, by the way, when you start at 50% and go down, you can never get higher than 50. Just so you know. You should just start at 100 and work your way down. Michelle.
Yeah, kind of going off of that, it depends on, if you're an active real estate investor or not. And to me, yes, your credit is at risk, but if it's not something that you plan on doing regularly, even if it goes down for a while, or even if worst case scenario, you have a foreclosure, there are loan programs that, after a few years, you could still qualify for those. So if you're just doing it once in a blue moon to make extra money, then is it really that big of a risk?
So let's say you go out and you are on a seller presentation and you meet somebody that makes $45,000 a year. They don't have any debt and they want to sell their house. You buy their house from them and you're like, hey, are you interested in being involved as a loan partner? We could pay you, $3,000 to $5,000 for every loan you sign on. And you could probably sign on 4, right, in any year. And so they look at that and they go, that's $12,000 to $20,000 that they could make in a year. How big of a deal is that to someone in that situation? That's huge. That's I just made 50% more this year. Is that worth it to them? Yeah, probably. And that's a real life story. The guy disappeared, but he was willing to do it. So, James.
I think for me, one of the biggest factors is who I'm partnering with. Because if I'm partnering with somebody like you that's done a ton of deals, that I know has a really keen eye on deal analysis, that's a safe bet for me. So I'm willing to take a lot less because it's a much higher guarantee. But if I've got a buddy that owns 2 rental properties and he's like, hey, I think I got this deal, I just need you to sign on the loan. That's a much higher risk thing for me. So I need to get a bigger cut of that to make it worth my while.
Yeah, and I will just say, I appreciate the comment, but there are definitely, early on, I was in one mode. In the middle, I was in a different mode. And, recently, I was in a very different mode. So if you just signed on in different times, you'd have had different levels of risk, right? Even though I just thought it was Brian. I figured he was, good to go. So, it depends on where you're at. Does anyone else have any comments? All right. So, what's it worth? They are risking their credit. They're bringing the majority of the funds needed to buy this house, right? Shouldn't they get a lot of it? So how might you structure the deal, right? A single fixed payment at closing. This is one of the ones that I think is fairly easy. Hey, you know, Royce, you're signing on a loan. I'm going to give you $5,000 hard cash at closing. And that's all you're getting. And the rest, it's on me to run the deal.
Those that are coming next week, you should pay really close attention to all the different ways to structure these, because you'll have an advantage next week.
Yep. Write it down, because you're a loan partner. There's no way you're anything but a loan partner next week. I'm going to love it. So a single fixed payment. And so there was a time when we weren't teaching this class, I don't think, but we asked, hey, you know, what's the amount you would take in a single fixed payment for a loan? And there was someone in the room who raised their hand and said $800.
No. Whoa. Are they here?
No. But that's, you got to remember, if that's somebody that's new to investing, who wants to invest with someone who's experienced and is willing to learn, right? Part of that deal might be, I'm willing to take $800 or $1,000 or $3,000 or whatever, but I want you to show me what you're doing so I can learn, right? There's all sorts of factors, but this could easily be $3,000, $5,000, $7,000. James.
This reminds me of the interview we did with Mary, where she basically said from the front of the room that she would have done the deal basically for free just so she could have learned how to do it.
Yep.
Yeah.
Yeah, and that's the point where, like, so if you heard the interview with Mary, there was a point in time when we were sitting in where are we sitting? In some restaurant, the Culver's. We were sitting in Culver's eating like ice cream or whatever they have there, I don't know what it's called. Custard, yes, thank you. After class, and we were talking about this, and she was like, well, there's this deal, and I'm like, let's do it like, you know, what would you do it for? And she was like, I'll do it for 10%. And I was, you know, and I was like, and I pressed on it, and I was like, well, you know, that's a lot. Would you do it for less? You know, and basically she eventually was kind of like, yeah, I'd probably just do it for free because it's you. And I'm like, and then we stopped and we're like, that's like the worst negotiation you could have ever had. So while I appreciate you wanting to do it for 0%, you can't do that, right? Like, you've got to stand up for yourself. So that's one way to do it. This looks a lot like paying points to close a loan. If you go to a hard money person, how many points are you going to pay them? Generally, 2, 3, 4. Sometimes 5, sometimes 1, but 2 to 4. So if you're taking a loan for $200,000, is paying 2 points for $4,000 or 3 points for $6,000, is that unreasonable? They're not getting the interest because it's not their money, but they're getting points. There's already kind of a precedent for this. Recurring yearly or monthly fee. So instead of paying them a one-time thing up front, one of the things that I like to do is I want to have my partners engaged over time. I don't want them, hey, here's $5,000, see you never, right? Because like in 2 years, she's like, pulls her credit, no, it's still on there. Brian, when are you getting rid of that loan? Like, when are you getting it out of my name? Because she's not getting any more money. She's just like, how fast can you get this off my balance sheet, right? And I'm like, 28 years from now, right? When they pay it off, and she's like, that sucks. So thinking about that, if you paid them instead of $6,000 up front, if you paid them $3,000 up front and $1,000 a year or something like that, where it's constantly they're getting money from the deal, what's their mentality? The deal's going, it's going well, I'm getting money, I get this check every year, it's like free money. Royce.
Yeah, I was gonna mention earlier, but I think that duration is actually a big component of how long am I gonna be on the loan, how long are we gonna own this property.
I cover that later, yeah.
You know, duration, though, does automatically come into play if it's a percentage anyway. So if it's percentage, duration is sort of automatically baked in.
Yep. Yes, but he may not want to be on a loan for more than 5 years.
Agreed.
You could have a percent of cash flow. This is very straightforward. Hey, you get 50% of all the cash flow that comes in. You get a percent of the equity. Same thing. When you sell the property, this is the percent of equity that you get. You could have a percent of both, right? There is no right or wrong way to figure this out. It's depending on the partner's need. If the loan partner is just like, I just want cash flow, I don't care about the equity because I need cash flow, I need the income, then great. Give them some cash flow. Take the equity. Figure out what makes it work for them. Or any combination of the above. So if you're going to be a loan partner next week, which is a lot of fun, those are some ways you might actually negotiate your deal. Any questions on how you might do that? Jason?
What's the single craziest structure you've ever seen? We'll cover that next week. Okay.
Yeah. Thank you. So next role. Any other questions on loan partners? Money partners, right? How to partner as a money partner. This person's bringing the cash needed, 20 to 30% usually for down payment. What else are they going to have to do? Initial backup funds, any CapEx, any initial like fix up that needs to be done. They're also going to supply reserves, right? This starts to be a bigger chunk than, oh, I thought I was bringing $70,000 for down payment, but really I'm bringing 85 because there's 5K in fix up, we want 5K in reserves, and I've got 5K in upcoming CapEx. They're also responsible for capital calls. Does anyone not know what a capital call is? Perfect. Nice work. Joe's just going to take one.
Why don't you cover it for the audio anyway?
So capital call is, hey, something happened to the property. Had a tenant trash it and we owe $20,000, but there's 10K in the bank account. Somebody has to come up with the money to pay for this, right? That's a capital call. So we go to the money partner and we say, well, for our operating agreement, you agreed to bring the money if we needed more. So now that person has to come in and bring more money into the deal. That's fairly interesting when you think about risk. James.
How much money in reserves are you recommending for money partners?
Seriously? That's the question you're going to ask? We taught a whole class on that. What do you think, James?
I think it's reasonable to do 6 months of principal, interest, taxes, insurance, and HOA.
Yeah. I think it depends on how many properties you own and how many are in the partnership. And
how many in the
all sorts of
partnership
stuff.
even more important than how many properties you own?
Yes. Yes. So if the property value goes down, who loses money first? Loan partner or money partner? The money partner, right? The bank has the lower 80%. The money partner has the higher 20%. So the property value goes down 20%. The money partner's money is gone. If they sold the house today, the money partner would get nothing. So whose money is more at risk, the bank's or the money partner? Exit strategy matters. So if you're coming into this and you're like, hey, we're just going to buy this, we think the property value is going to go up, we're going to sell it in 3 years, and that's your only strategy, and the property values don't go up, what are you doing? Now you got a money partner that's unhappy, a loan partner that's unhappy. You need to have more than one exit strategy. Other partners in this case, obviously responsible for both the deal and the loan. We covered that. Guess what the next slide is? Time to play what's it worth. So, percentage of the deal. Money partner, they're bringing 20% down payment plus reserves plus any fix-up needed. What part of the deal is that worth? Say 80, is 80% again? It's 160% in this deal. Wait. Bob says the majority, and he already gave 80% to the loan partner. Which one should get more?
Well, I agree that the money partner has more risk than at first glance when I first tossed out my answer.
Sure. So who would you give more to? Just if it was just loan partner and money partner, who gets more?
My inclination would be to partner them up at the same and give them the majority, and the deal maker would be less.
Okay, so let me do it this way.
So that would be,
I need you to bring a check next week for $80,000, and in the future, if any shit goes wrong with this property, I need you to bring $10,000 every time stuff goes wrong. How much is that worth versus I need you to sign on some papers?
well, okay, so I would add on the paper part of it, so we have knowledge of partnerships that have gone bad.
Sure.
And the guy that signed on the loan took a terrible haircut. So with that in mind, he lost way more than what would have been the money partner in that one instance. So
I would need details to fully understand it, right? Because
yeah, and
the money partner would have lost all their money, right? Before the loan partner loses anything.
yeah, and so I couldn't. It would be confidential. I
Sure,
couldn't
agreed.
give you these
Yeah, I'm
details,
not asking you like.
But just from that personal experience and understanding what happened in that deal and how much principal was lost, so this was a deal leading into '07, and the property was not performing.
Sure.
They couldn't make their payments. The bank came back to them and said, "Oh, it's '08 now, and we want our money.
Sure.
We're going to close you out, pay us our money," and it was the
And
loan.
they couldn't sell the deal.
They couldn't
Sure.
sell the deal, so the loan partner had to write a check for probably a couple million.
Balloons
So-
are for clowns.
Balloons are for clowns.
So it
Yep.
doesn't always go, you know, it doesn't always go where
Agreed.
it's the money partner is taking the biggest haircut. In that case, the guy that signed the loan.
Right. So depends on how it was structured, right? If it was structured such that the money partner should have brought the money in order to make the payments, then the loan partner would have been safer.
And it wasn't structured.
Right? So in that case, I'm going to call that's just shitty structure, right? For that loan partner. He just got a raw rap because the structure probably wasn't well thought through from his side. If he's responsible for signing on the loan and then if anything goes wrong, he's supposed to cover everything, unless he really is getting paid to do that in the deal. I mean, if he took that risk knowing, hey, I'm getting 70% of the deal because that's what I'm doing, then great, that's what he signed up for. But if it's not and he's getting 20% of the deal, you know, it's probably a bad negotiation, in my opinion.
I think it was one of those deals where, you know, they were only looking at the upside. And
Yep.
They never considered.
Oh.
They never considered if this goes bad, what does it look like for me, and how do we unwind this?
Yeah, and so again, I'm just say, I will put that in the pile of bad partnership, not necessarily loan partner getting hosed because they did the right things, right? I think that's a very different story where loan partner is responsible for the loan, money partner is responsible for the money. Stuff goes south, right? That loan partner in most cases has a house that they can go to the bank and say, hey, I just want to give this back, make it even, or even short sale, right? Something where the LLC should be what's responsible, but the loan partner is going to have to eat maybe some of it. But hopefully, you know, I don't know how much the deal was worth to make it a couple million, but you know, it doesn't sound like a structured, well-structured partnership.
It was structured for the upside.
Yeah, and that's not the way to do it, right? If you haven't had the conversation about what happens when everything goes to crap, you shouldn't be signing documents. So, who else thinks this is worth something? Michelle.
I would think the money partner would have to get a good majority, at least if you're thinking about it from like a cash on cash return. And I realize maybe I'm way oversimplifying this, but like from the loan partner and the deal partner, they're not bringing any money into it. So if they get 20%, then they're getting like 20% cash on cash return because they brought like nothing.
They're getting infinite return, right?
Right, exactly.
I put 0 in and I got money back.
Right. So with the money partner, any percentage that he gets isn't really a true percentage in the fact that he brought all the money to the deal. So from that standpoint, I would think it would have to be like, I don't know, 70, 80%. Maybe that's
Perfect.
crazy high. But
You're a money partner next week. Barbie has one.
I would say that every time a capital call is made, my percentage goes up.
Well, you're typically investing more money, and typically in your operating agreement, it's going to say, when I have a capital call, I'm getting this return on any additional money until it's paid back. So in a sense,
So it could be a
it's
loan.
going up. Your percentage is usually not going to go up in the deal. It's just going to be a percent-based paid out on that money. It could, yes, it could, but it complicates things from an IRS standpoint extremely.
Usually it'll be a loan.
Yeah, it's usually a loan.
You know, I think the thing that wasn't, or at least I didn't hear mentioned, was that the money partner is sheltered from the risk of having credit issues. You know, no matter what happens, they've already, I mean, that's all they can lose, basically.
Yep. What they put in is what they can lose, except in the case where a capital call comes and they need to put more in, and then more in. And at what point does the money partner say, I'm done putting it in, right? They see the market going down, it's Detroit, and they're like, I'm not putting money in, we're just done, right? And so then what do the other two partners do? And these are all things you need to think about when you create your LLC and your operating agreement. And
Oh, sorry. That was fast.
except you almost knocked his tooth out with the mic.
In a partnership deal, whose name's on the note? Is all three? So if it was three,
Nope. So
only one, right?
The LLC, if it's done in an LLC with 3 partners, the LLC, whoever is managing the LLC, will sign on behalf of the LLC, but that's not personal liability. That's just the LLC signing, right, which is required because it's going to be titled in the LLC, the property is. And then whoever's personally signing on the loan is personally signing on that note, and that's it. Okay. So it's typically not all the members. If you have an LLC that's like 2 people are 40% each, and then 2 people are, you know, or 5 other people are like 5% each, you might have to have the 2 managers that make up the 40%, or they will have a document that basically says you have the authority to sign on this as well. So it just depends on your title company and your loan company. All right. Nope. She says no. So how much is it worth? It's their principal. And this is really important to me, especially when I'm using other people's money, right? It's, in my opinion, much better to give all of the principal back with no profit than it is to lose any of the principal. I know that sounds stupid, but I would much rather not lose someone's principal. Guard their principal with your life. You lose principal, then you have to earn the principal back on your next deal, and then you start making profits. And that's difficult, right? If you look at the stock market in, 2000, when was the tech crash? 2000-ish, right? You look at that huge whoosh, right? And it's like, when you're here, you've just lost 40, maybe 50% of your principal. You're like, man, maybe you had $300,000 and you're like, yeah, and now you have 150. You've got to get back to 300 before you even feel good about it. So your partners are going to feel the same way. Their money's at risk first if the value drops, which we've covered. They may have to put in those capital calls. And what's the opportunity cost of knowing, right, on a $300,000 house, hey, a tenant might trash it. I might have to put in $30K. Do I need to save that $30K in a separate account and not invest it in something else? What's my opportunity cost of having to have this money readily available in case something goes wrong? That's something to think about. That's more risk for this person. So how might you structure it? Same kind of ways. Percent of cash flow, percent of equity, or percent of both. You could also do a preferred return. Where's James? So you can say, what is it? Fructus, de minimis.
Primus fructus, first fruits.
Right? So basically, you could offer a preferred return to this person where, hey, if we just make 4%, you get it all. After that, we get even splits, right? So that we want that money partner to be happy. That's one way you could do it. Don't use the word guarantee. Why, James? Why should we not use the word guarantee?
The SEC and the government doesn't like it.
Yeah, there is one exception to that. Even though it's technically not guaranteed, the actual term is called guaranteed payment. And that's how it's written in the operating agreement, even though it's not a guaranteed payment, but that's what it's called. So a guaranteed payment would be, an example would be for a loan partner where Royce signs on the loan and I'm just like, hey, in the operating agreement it says you're going to get a guaranteed payment of $300 every month. And basically what that is me saying is, regardless of how the property does, you're going to get $300 a month. However, if everything goes to crap, he may not get his $300, right? It may just not be there. So, or any combination of the above. So if you're a money partner next week, you can have fun with that. Partner is a deal maker. This person brings the deal. What else does a deal maker do? All the legwork. Is it a lot? Yeah, no, maybe. Yeah.
It's property management too, right?
Could be. Yeah.
It's property management too.
In this particular case, the way we structure it for next week, it is, but it definitely doesn't have to be, right? So they might do on-market MLS or off-market marketing. Does off-market marketing, is it free? Some of it. You could go door knock. You could go, make calls to Craigslist, for sale by owner ads, try to find a deal. But if you're sending postcards and you're sending enough to get a deal, how much does that cost? Chris, how much does that cost? Lots, Chris says. I mean, it's not cheap. If you're going to send out 1,000 postcards every month to try and find a deal, that's money that the deal makers are actually investing to bring the deal. They work with brokers. They identify the deals. They go out and they look at the properties, right? They're going to analyze them. They're going to write offers. They're going to do the negotiations. They're going to do the inspections, right? All of this stuff, it's a lot of time. When you buy a property, that's like the busiest 30 days, in my opinion. Because, I mean, for me, after that, I turn it over to property management, and then it's fairly easy. But that 30 days is like getting everything set up, bank accounts, insurance, all that stuff that you have to do, right? And in many cases, then they already go and they find partners. A lot of them will have them lined up. In our example, they also handle property management. This includes leasing, rent collection, if you have to do evictions, regular inspections, financials. Don't forget, you got to keep the books, right? Can't just be, I brought the deal, you brought the loan, you brought the money, we're good, right? Tax prep. How many of you enjoy tax prep? Other than Jason? Yeah, my CPA enjoys it when I send it to her, when she sends me the bill. Entity creation, right? You've got asset protection that falls under this. Communicating with others involved in the deal. This might be this person's role as well. Strategic reviews, exit strategy, right? The deal maker could also just simply be a bird dog. Hey, I went out, I found this deal. Joe, would you want this deal? And he's like, I'll take a look. And I'm like, hey, if you close on it, I just want like $500. And he's like, okay. And he goes and he closes and he writes me a check for $500. That could be a simple deal maker. Now, he's got to go do his own property management, all the rest of this stuff. Or they could simply be a wholesaler, right? Hey, I found this deal. I invested $3,000. If you guys just pay me $7,000, I'm good. I'm out. You guys can go partner, loan and money partner together and take the deal down. Those are some thoughts for next week. Other partners obviously responsible for money and the loan. So, what the hell is this worth?
80%.
80%. Bob's doing a deal with James. It's a 240% deal. They each got a third. Check that math. It's like toilet paper math, right? You see like 8 rolls, 240 sheets, and then the next one's like 15, and it's like 300 sheets, and you're like, how does that work? Next time you walk down the toilet paper aisle, you're going to laugh. You are not laughing right now, which is fine.
Are you saying doing everything or just
Yeah,
The way we structured it, yep.
doing everything.
So what is that worth?
15%.
15%. How much is property management worth? 10%.
But it's not 10%.
Yeah. So property management is worth 10% of the cash flow. So for all the other stuff, you're willing to give them 5% of the extra cash flow and 15% of the equity. All the rest of that crap they have to do.
Hold on a second. You're talking about two different numbers. You're talking about 10% of net cash flow.
Yes.
When you're talking about a partnership.
Good
and
point.
Property management is 10% of
Yes.
gross
Yes.
cash flow, which might be
Yes.
$30 versus $180.
Yes. So let's assume it rents for $2,000, right? What's property management getting?
200.
$200 a month. Our whole cash flow might be $200 a month on the property, right? So are you going to give them $200 a month plus 15% equity? Is that a yes?
They need a guaranteed payment.
Did you say the word guaranteed?
She used guaranteed payment.
Guaranteed payment.
So, but this would be all the cash flow for them, the entire deal, just for them to do property management.
How does the loan partner and the money partner get paid?
Yeah.
Doesn't the money partner need a return on their money?
So the money partner doesn't need any cash flow, right? I mean, this is the complication of doing deals, right? When you start assigning roles, there are some predetermined like norms for the industry. It's 10% for property management, roughly, right? So
The
James.
deal partner gets paid in a tax deduction.
The deal partner gets paid in a tax deduction.
Or the loan partner gets paid with his tax deduction.
It's going to be split accordingly to the LLC. All those deductions are based on your percentage ownership in the LLC. So what's this worth?
80%.
Stop saying 80%. Gosh.
1/3.
Royce says 1/3.
I think it's 15.
15. I'm just saying 15. You're saying 15 and I'm saying 15?
So let's just put some just random numbers to this. If you were making, I don't know, $30,000 a year on a deal, $20,000 a deal in a year, then you're saying 15% like, what, $4,500 a year for paying the deal maker?
Well, I assume you're talking equity and cash flow.
Yeah, everything.
Yeah, so they're not really seeing that. They're seeing like 15% of 200.
But even like over a 3-year period, they're seeing $4,500 per year.
Yeah, if you sell it.
Sure.
But what's that per month?
Oh, like nothing. They're early up.
$30 a month during the process for the deal maker to do all the property management. Are you going to do the property? Do you want to be the deal maker? You're a deal maker next week.
Yeah.
Yep.
And then we got to make sure.
And what I want to happen is I want you two to partner with Michelle, and I want to see what happens. Although we don't let you guys partner.
She only wants to be 15%. That works.
Yeah, until she starts negotiating and seeing she's getting $30 a month, and she's like, I'm not doing all this work for $30 a month, right? And these are the struggles. This is why we do this in class, because there's no right or wrong answer, right? It's going to depend on your partner. It's going to depend on the roles and responsibilities, but it's difficult because whatever role you're in, you're like, this should be the most, right?
80%.
Like, This is why James says 80% to everyone, because it's his starting point. He's like, yeah, I'm going to be the what? Loan partner, 80%, right? You should just start at 100 like Jason's going to do and work your way down. Bryce.
So, and just to address you on this, I think that the deal maker makes the difference too, right? If I'm an experienced deal maker and I'm bringing good legal backing and good CPAs and great systems and processes in place, right? I'm probably doing that for a larger percentage of the deal, right? So the deal maker that you may get that's willing to take a small percentage, maybe somebody who has none of that in place, right? And so how active are you going to have to be involved as the money partner?
Yeah, yeah. Jason, to the back of the
And what's your
question.
return on investment as a deal maker?
Depends on how much I spend on marketing.
The way I look at it is, how much am I willing to pay somebody else to do all that other shit that I don't want to do?
Yeah.
But
no
how much
doubt.
are you willing to pay for the deal? Because it may be that they have an
Right.
amazing deal that you don't otherwise have.
Yeah, and that's part of the key too, right? Is like, if the money partner walks, can you go find another money partner? Yes. If your deal partner has an amazing deal, are you willing to negotiate? Are you willing to just be like, nope, I'm only gonna give you 15%, and they're like, fine, and they walk next door and they get 40%, because it's an amazing deal where everybody's gonna make a lot of money. So this is it depends, right? There is no right answer. Michelle.
I think it should be a smaller base percentage, and then especially if they're doing property management, they should do a percentage of the increased cash flow if they're able to get higher rent or to market the property and, put in laundry machines or different things that increase revenue over time.
But if you're a property manager, if you simply went out and started a property management business and property managed this property, you would essentially already get $200 a month. Now you're getting 30. Are you incented to make it better so you get 33?
Well, that's why I say that you have the base amount.
But what's the
You
base
have-
amount? 200? Because otherwise, are you incented? I mean, hey, if you go see a 50% increase in cash flow, you're going to move your salary from 30 to 45. Like, do you care? I don't, and not enough to go do that hard work.
We'll make the whole thing based off that.
Right. See, we're back to misery, just right above this.
So you talked about the marketing, right? You got
Mhm.
the costly marketing,
Yeah.
right?
So if you spend $3,000 on marketing, you want that back.
I want that back.
Right away.
Do you know what else I did
What?
to get this deal? Do you know how many doors I knocked
Right.
on? How
How
many people
long
I
that took?
called?
Yeah.
This is literally my salary.
Right.
Don't call me for $30 a month.
Right.
Not interested.
Yep. But if the most you can get is 200, because that's all the cash flow there is.
And in a lot of cases, you've looked at 20 deals and you put 3 under contract where 2 of them fell out.
And
this
one
is
of
the
them,
one,
yeah, one
this
of them
is
got
the one
bought.
you're about to have done, and you have all that work built up in there too.
The question I have is about like commingling the roles. So having the deal finder bringing money in,
Sure.
or having the loan partner have money in the deal. It seems like that would almost simplify the splits in some
Yeah,
ways.
it simplifies it if it's all the same person, because then it's 100%. Otherwise, it's really difficult. There's no combination that you can make up where it's just like, oh yeah, it's 10 and 90, right? Because you can argue that it's really 30 and 70, or even 50-50, right? You bring all the money, the only person that you're just signing on the loan, you're going to do everything else. How much should you get? You're basically in control of the deal. How much does a loan partner get in that case? 80%. The loan partner gets 80%? Excellent. We have 2 loan partners for next week, right? It's hard, right? I'm just trying to point out that this is not easy because everyone has a different opinion. So, how much effort and money did it take to get this deal? How long did it take to get a deal? Did it take you 3 months of your life to try and get it? How big of a role did they play to get it closed? How much did they get paid for property management? Financial tracking, right? This sucks. Financial tracking is still time consuming, right? What's it really worth if they don't sign for the loan or bring any money? It's not much, right? I mean, we just figured out that it's worth something. So how might you structure this for the deal maker? Single fixed payment. What does this look like? If you just somebody brought a deal and you paid them a one-time fee, what does that look like?
Wholesale fee.
Yes. Right? Could be a bird dog, could be a wholesale fee. Property management plus bookkeeping plus other fees, you can go add all this up, figure out what that's worth, and try and pay them based on already established, like, normal criteria for the business.
Sometimes the tricky part about that is that it eats into current cash flow, and so the like money partner gets like nothing. Or,
Right.
Yeah.
And so, go ahead.
You could structure it too, where the deal maker gets a little bit up front, and then when the property sells, they get, 40%
Yeah.
of the deal.
Yeah, I mean, if the deal maker's like, I don't want cash flow, I just want a lot of the equity, that's great. They could be like, I just want all the cash flow, you guys can have the equity later, I don't care, right? There's all sorts of people and different types of personalities that want different things based on their current needs.
Yeah, and the deal maker a lot of times is doing the work as you go. So you're like putting in all the effort weekly or
Yes.
monthly or whatever it is, and then you're not getting paid till the very, very end if you get paid at all.
Yeah, so there's a partnership that I'm involved in that I started, so it's my own fault. But the way the partnership is set up, and I'm a money investor, and I signed on the loans, and I manage it. So I do a lot of it, and the other people are just money partners, and I did a preferred return. And so all the money that got paid in, and it's a structure I'm going to talk about in a little bit, but essentially I do all the work, but I won't get paid probably for any of that work at this point for like another 4.5 years.
Sounds like a great deal. Can I be involved in that?
You
partnership?
are. Yes, and it is a great deal, right? Because I do have money invested in it, so I get paid just like everybody else on the money that I invested, but a lot of my work is signing on the loan and managing it. And so I actually don't see that, and I'm fine with that because that was the intent of the deal, but I would probably structure it differently next time. So, Jason.
This becomes very obvious where you've already mentioned on a couple other roles where you're doing a different percentage for the cash flow and the equity.
Maybe not.
Okay.
I mean,
Yeah.
you could argue that you don't. You could argue just make it work with just one fixed percentage, or you could
Yep.
split them out.
Yeah, and there's an infinite ways to structure deals, right? So again, they could get percent of cash flow. They could just get a percent of equity. So when I say percent of cash flow, it means James brought the deal. We're going to give him 100% of the cash flow and nothing else. When I say percent of equity, I'm like, James is going to get 50% of the equity, but he doesn't get any cash flow. When I say both, he's getting some percent of both, and it doesn't have to be the same percent. So if you're showing up next week, which I highly encourage, remember this. And we'll cover it again next week, or any combination of the above. So, by show of hands, you can only raise your hand once, and you must raise your hand. So decide now what you're going to pick. Which one is the most important in your mind? There's no right or wrong. How many people think it's the deal maker? We have 1, 2, 3, 4, 5, 6, 7. We got some peer pressure going on here. It's like 4, 5, 6. So we got 7. All right, how many people think it's the money partner? We have a majority. How many people think it's the loan partner?
I have to stay with that.
I am so excited for next week. We're going to make him the loan partner, and everyone else is going to be deal and money partners. We're going to make him find a deal. Who else raised their hand for loan? So we got 3 for loan partners. So you can see, in normal context, I think you will find that most people think the money partner is most important. Because if you think, would I rather bring $80,000, sign on some papers, or find a deal, in your mind, you go, $80,000 is the worst, right? It's the hardest one to do. So I'm going to burn through this because we got quite a few slides to go. That's the kind of make you think portion where really when you come next week, you'll have to encounter those same thoughts. So spend some time thinking about it. The goal in my mind, and hopefully in your mind, is to negotiate a win-win-win. And in some cases, this might be the loan partner gets 5%, the money partner gets 50%, and the loan partner gets 45%. And you hear those percentages and you immediately go, oh, not if I'm the loan partner, or not if I'm the deal maker. But in some cases, that's a win for all of them. Just like when you're doing seller presentations. How do you find the win for the person you're trying to buy the house from and make it a win for you, right? You're not trying to screw over your partners. You're trying to find what works for you that also works for me. Highly encourage you to start all of your negotiations from this point. Put yourself in their shoes, and that's what we just did, right? So if you're in Bob's shoes and you're like, I'm a loan partner, I want 80% of the deal, why does he think that way? What is going through his mind? And then when you're the money partner, you're like, I want 80% of the deal. You try and get him to understand your side. That will happen next week, and it's highly entertaining and interesting. So remember this. If you argue that as the money partner, you should get 90% of the deal, And next year, you do a deal as a loan partner. Don't expect to get 90% of the deal then. Expect your money partner to get 90% of the deal because that's what you negotiated, right? You're probably going to play different roles at different points. Be fair, right? Don't overdo it. If all partners approach the deal with this mindset, I think you'll have a much better chance of a long-term winning partnership. And this, what does it lead to? More deals, more partnerships. This has been true for me for sure. A few examples. You want to run that for me? So we're going to run through a couple examples in the spreadsheet. So for those of you who don't know, there is this, yeah, I still need that, I guess. Let me go through this slide and then we'll pull Excel up. There is the capability in the analysis spreadsheet on the right side. If you don't have a really wide monitor, you'll have to scroll to the right. You may not even know it's there to basically plug in numbers and negotiate what partnerships would look like. So here's deal number one as an example. It's a 17-plex, has 12 2-bedrooms, 5 1-bedrooms. This is actually a real deal. Needs 10 new garage doors, some bathroom remodels, a unit remodel, some paint, some flooring, a bunch of deferred maintenance, hallway flooring, new interior doors. Lots of deferred maintenance and upcoming CapEx. Purchase price, $1 million. Loan terms, 30% down. Looks like $300K plus $15K in closing costs. It was basically a 10-year loan with 10-year balloon and 30-year amortization. Interest rate was 5.3%. Rental income was at $9,700 a month plus $100 a month for laundry. Rent is well below market and should rise quickly. Utilities are not being billed back. Garages are not rented. There's the taxes, insurance, and utilities. I don't expect you to analyze the deal, but let's go to Excel. That's still PowerPoint. There we go. So this is all the deal. Just go to the far left and top. So click on 17 unit tab. So this basically shows purchase price $1 million. It actually appraised for slightly higher than that. Down payment, all the numbers that you just saw are plugged in. So if you want to scroll down over here to cash on cash, just so you can see it. Cash on cash in year one is negative. However, rents were really, really below market. So it was about $9,700 a month. It was estimated within the first 2 years you'd probably get to $14,000 a month. So that's what this shows. And it starts to show, hey, this starts to look really good. Your cash on cash starts to get towards 17, 20, and then continues to rise. So you want to scroll down first, sorry. Down here basically shows your total profit in each year. Yeah, you can widen those if you want. And so if you want to look in the spreadsheet, we can kind of go across to the right and up. This is fun. It's like driving without having the wheel. I'm going to just move it this way. Nope, this way. Nope, other way. There we go. You should have timed this. It would have been looking really cool. So over here, you basically have the ability to plug in what percentages you want to actually have your partnerships or your partners have. And I'm going to just explain the sections really quick. Money partner 1 and money partner 2, these are really obvious. It's just, hey, I've got one money partner. You fill in one money partner. Here's the percent of cash flow. Here's the percent of equity. If you have a second money partner, you can fill in their cash flow and equity as well. Deal syndicator, that's kind of the deal maker, right? So what are they getting in cash flow and equity? Right there. Credit partner, kind of two different ways. Deal-based or fee-based. So hey, I want to pay him $3,000 up front and $1,000 a year. You can plug that one in right here, or I want to pay him based on the deal in cash flow and equity percentages. You could also do, even with one credit partner, you could plug in stuff for both of those and just add them together. And then down here, you scroll down just a little bit. So money partner loan-based is, Royce is a money partner and he's like, I don't really want to mess with any of this. I'm just going to loan you $80,000. I wanted it 10% with 2 points. And he's the money partner, right? So that's what this is. How many points are you going to give him? What's your interest rate? And what's the amount of the loan? Do all of those roles make sense? You don't have to use them all. You can use 2, right? If you're just using 1, it's just you. You can just use the left side. But you can plug in whatever you want for however many partners you need. So as an example, let's just start with a third, a third, and a third. Deal-based for all of them. And this spreadsheet is available on James's website where, I don't know where it is. jamesorr.com/spreadsheet, something like that.
Yeah, just email me. I don't know where.
Just email James. Everyone, all at once.
My email address is brianwee.
No, it's not. So, just scroll this way and kind of widen AY and column AY and AZ. So this basically shows you if this is what you decided to do, a third, a third, and a third, right? Interesting starting point. I mean, you could start here on every negotiation and then decide what's it really worth. So our money partner, right, cash flow, we're losing money in the first year because rents are low. But it starts to pull out and starts to look really great 5 years from now, right? Equity, same thing. Total profit, $11,000 in the first year, $32,000, $65,000. You need to put investment in here of $315. So that's the money they're actually bringing. And then you can see the annualized return. So you could start here, and your money partner might go, yeah, you know, in year 5, I'm fine with getting a 14% return on my money. Or they might be like, there's no way, right? And they're like, you know what, I need at least 50% of the deal. So raise that to 50. And then somebody's going to have to lose some stuff. So maybe the other two are 25 and 25. So plug that in for me, and we'll talk about that. So your deal syndicator, right, in year 1, are they getting the equity? No, because we haven't sold the property, right? Let's say we're going to hold this for 5 years. So they're actually $3,787 that they're actually going to need to come up with in order for them to have this. And you may be like, well, that's the money partner's role, and you can basically say, well, we need this much extra and plug that in for an extra amount that you need to put in initially to have the reserves to pay for that deficit in cash flow. And there's a spot for that on the far left in initial reserves. So
Or it's 0 for the first year, and then they get reimbursed.
yes, but there's going to be a shortage.
Right.
So someone has to pay the shortage. Right. So in this case, you know, year 2, deal syndicator. Is the deal syndicator happy if you went and found this deal? Are you happy in year 5 with $167,000? No. Is anyone happy with $167,000 for finding the deal and managing it? Are you sure? 17-unit apartment building, you're property managing it. Suddenly everyone's like, no, right? So you could also decide, hey, we're going to pay a property manager and take that out of the deal syndicator's pay, right? Is it going to cost that much to actually pay a property manager? No. Oh, sweet, we have property manager in there. Even better. So that's property managed. So yeah, I'm pretty sure everyone's like, yeah, I'll take it now. So where's credit? Credit partner, same thing. Are you happy as a credit partner getting what amounts to negative in the first year or 0, about $1,000 in the second year, and then starting to make some really decent money in the 3rd and 4th year? It's a home run for a credit partner, right? Do you think that's a home run for a credit partner? That's only 25%.
It's a good deal.
Huh?
It was a good deal.
It was a good deal. Yeah, they brought 80% of the money. Stop having this conversation. James and I have had this conversation at length and gone down a really long rat hole. We're not doing it tonight. I don't have time for it. So what's interesting is if you looked at this and you were bringing the deal, or you were the money partner and you were like, wait a minute, I'm going to get, you know, $60,000 in cash flow and the credit partner is going to get $30,000? Like, no. Like, I'm going to get more of that cash flow. I put all the money in, right? All they did was sign on a piece of paper. Could you very easily see, instead of 25%, can you zero those out and scroll up?
0 on just the cash flow?
Both.
On the credit partner?
Yep, and equity as well. And then go up to credit partner fee-based. So what might an initial fee be for the credit partner? They're signing on a $700,000 loan. Let's call it, what, 3 points? So 21,000, plug in yearly fee, 90,000. James is the easiest partner you will ever have. Just give him $90,000 a year. And then, you know, $21,000 initially, and I don't know, let's even call it 1 point a year, 5,000, that's fine. So that's what they're making. You need to change deal syndicator or change money partner to 75 each. Down, 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 money partner, there you go. 75, 75. So, does this seem more reasonable? The credit partner basically gets a big check for $26,000 or $21,000 the first year and $5,000 every year. Does that seem reasonable for signing on a loan?
Well, it's a little more than that. It's an $800,000 loan now. Just kind of make an argument.
700, yeah.
Yeah, whatever.
Yep, agreed. So, I mean, you're getting 3 points plus you're getting some extra payment. Interesting. Deal syndicator, making a lot of money for bringing an amazing deal, right? Money partner, making a lot of money for bringing all the money. Could you see how 3 partners could do that deal in those percentages? No? Why not? We need the mic in the back. Royce is going to run it? Oh.
It just doesn't seem like enough for the credit partner because he's got his credit tied up long term. $700,000 loans a lot to be tied up for anybody's credit. And the reason you're in this deal is because the money partner and the loan and the deal syndicator couldn't get the loan on their own. The reason they needed you is because they can't get the deal without it. So
maybe.
I mean, that's.
They just may not want to sign on it.
Right. So they don't want to sign on it because there's not enough money in holding that loan for that long for them. I think it's worth more than a 5. I mean, 21,000, 3 points up front. Yeah, I think that's reasonable. The yearly fee when they're making considerably more than that seems less reasonable.
Sure.
So a higher yearly fee would make it more reasonable.
He doesn't want to tell me why.
No, I was echoing the same.
Okay.
So I agree with him just because it's hard. I mean, I've gone to banks and tried to get $1 million loans before, and that's worth something far and above what I think is up there because you have to be able to support the $1 million loan or the $700,000 loan. The bank's going to come and say, well, how are you going to pay this back if things go south? And that's worth
So
something
commercial
far
loans are
more in my-
actually, so I've done both. Commercial loans are actually much easier to get, especially at this level, than a normal like loan on a single family home, right? And in most cases, the bank is more looking at will the property support the loan than they are you as a cosigner or a signer going to be able to pay this back, right? They really are looking at the property a lot more. You still have to be good financially, right? There's no doubt, and it's not like anybody's going to just get accepted for the loan. But I actually think that's I would much rather get a commercial loan than a Fannie Mae loan just for the process, right? Yeah. And the ease of getting the loan. It's like Fannie Mae, hey, give me every piece of paper you've ever written on since kindergarten.
Were
right?
you
It's
trying to
ridiculous.
do like a construction loan?
It was a land loan, so I get it.
Yeah, it's that's
Yeah.
hard.
Yeah, so in this case, I mean, a lot of people could get this loan, right? Probably more than you would think. And the higher the loan amount gets, the more they look at the property because there aren't tons and tons of people who are like, well, I'm going to sign on a $20 million loan and I have $20 million cash in the bank, right? That just doesn't exist in a lot of places. So banks know that and they're looking at the property and they may require we need you to put more money down, but typically it's much easier, which is one benefit of commercial. The downside is balloons, right? Typically you're going to only get a 7 to 10 year loan and the rest is going to be a balloon.
And the size of your network is going to impact whether it's a reasonable fee or not. Because if you know 14 people that are willing to sign for this loan, then you're not going to have the pressure to have to pay more.
Yeah. So, I mean, you could plug in different numbers here and make it, hey, we're going to give you $15K up front and $15K additional every year and have that negotiation with the partners. But it's a very interesting, and this is a home run deal. And it turned out basically, for the most part, like it says on this sheet. Going to move the mouse just a little. So even then, I mean, is your deal syndicator happy? They're still making $30,000 in cash flow across 5 years and a little more than $100K in equity. Your money partner who put a lot of money in is making $88K. They're getting a really good return. Like if you're a money partner and you had $315,000, how many of you would do this deal? 27% return. I would do that deal.
Well, it's only less than 1% in year one.
Right. There's some risk. Yeah? All right. Shut it down. Go back to PowerPoint, please. So you can use this spreadsheet to basically go through this. Let's make sure we covered it all. I think I got all that stuff covered. So just really quick, I'm going to need you again, James. Same thing. Deal number 2, smaller size deal, just so you can kind of see the difference. It's a $405,000. Not yet. It's a 6-plex, 5 2-bedrooms, one bath, shared laundry, probably $10K in the first year of deferred maintenance. There's your cost. Here's your loan terms. It's 25% down, so about $100K. It's a 10-10-30 at 5.3%. Here's your rental income. Doesn't nearly have the same room to grow. It's only like $4,300 to $5,000. And for those of you who've been to previous class, this is that 6-plex that has all the cockroaches. So back to Excel to kind of look at this one. Click on the 6-unit tab. So all the numbers are plugged in here. Scroll across, right? Cash flow on this is much tighter. So just start a third, a third, and a third again, just so we can kind of have a baseline. Deal syndicator just got lucky. Got an extra percent. Oh, you deal made this? So you can see cash flow in year 1 is negative, right? Again, so the money partner is going to have to come up with that. Put $101,250 in for money partner 1 investment, just so we can see annualized ROI. So, you know, you're looking at about a 12 to 13% return for the money partner right now at a third of the deal. For some people, like if this is your friend or your mom and they're putting this money in and you're like, you show them a conservative estimate of this and it's like, hey, you know, 8% seems like about where we think we're going to be. There's some upside to 12 or 13%. And then you do this deal and that's what they get. That's amazing. If they get 8%, they're probably still ecstatic, right? Anyone have numbers they want to plug in or do this in any specific way? It's up to you guys for this deal. Jason. You need to change deal syndicator and money partners percentages. James, which one are you?
I did the credit partner on this deal.
Yeah.
What do you want to do, really? Anybody want to do something?
So what is the credit partner? What do you guys want to put in for credit partner?
We put it back at 30, 30, 30.
Sure. 33.
So when you look at this and you go, let's pick year 3. So right now everybody's getting about 40K. Does that seem fair?
No.
Who should get more?
Money.
All right, money partner. Let's get them to 50%. Who should get less?
Deal.
The deal. All right, so leave credit partner and put deal down to 17. All right, so deal syndicator in year 3, they're getting 20K. Credit partner's getting 40K. Money partner's getting 60K. So we got 20, 40, 60. Does that seem fair?
They got paid $500 a month for property management of 6 properties.
They did have cockroaches.
Right? Isn't that what it is? $500 a month? Yes.
Yep.
Does it include property management or no?
This probably includes it too. It does.
I would manage a 6-unit with cockroaches for $500 a month.
Yeah, you don't even have to in this case. You're just literally bringing the deal and doing all the bookkeeping and asset protection and tax returns and all that. So property management is done in this particular example.
I would do this deal.
You would, as who?
Any of these 3 roles.
Any of those 3. So you take 17% for deal syndicator, a third for credit partner, and 50% for money.
I would do this deal, as said.
Cool?
We're going to talk after class.
Yeah, I know we are.
So how many of you would do this deal as deal syndicator? If you knew it was going to sell in year 3, all you do is you bring the deal, you're going to deal with the property manager, and you're going to manage the books and set up asset protection. Are you willing to do that for 20K across 3 years? Yep. How many? How many would not? A lot more for how would not. How much more would it take?
Plug in 25 for that.
So go to 25 and 25. It's going to take you to 30K and 30K. So you would do it for 30K. 10K a year to manage a property manager, send in some tax returns.
Yes.
Yep.
So this is where I say, if you're like, no, if you had 10 of these deals, would you be willing to do it 10 times and make 100K a year?
Yes.
Right? I mean, that's the dilemma. It's not, hey, just look at this one deal in a vacuum. It's, could I do multiple of these deals and bring those and make good money by not having to sign on a loan and by not having to bring actual money? That's the benefit of the deal syndicator. Credit partner, you're getting 40K or 30K in year 3 for this. Like, I look at that and I go, man, that's a lot. Like, I would rather see the money partner get 60 or 70% and You know, the credit partner and the deal syndicator get a little less personally, but that's only if I'm the money partner, right? If I'm the deal syndicator, I like this.
Yeah, like as somebody that's not the money partner in this deal, if the money partner got 15% ROI annualized, I think that's a pretty decent return.
Yeah, and
It's relatively small.
I don't.
Unless you're the money partner.
Yeah. If you're the money partner, you're like, I want 25 or 30, right?
I'm the first money at risk.
Yeah, because I'm the first money at risk, and if I did this deal myself, that's what I could get, right? And so it's this weird conundrum.
Or two of them and get 30%.
Yeah, I mean, in a previous point in time. You want to minimize this? Go back to my slide deck, please, so I can finish like 10 slides in 2 minutes. Operating agreements. Maybe it's 15 slides. So some basics. Operating agreement defines how the company operates. I'm going to fly through this. It defines the purpose of the business, defines who are the managers, who are the members, and who does what, right? So we've taught this before. It defines ownership interests, how income and expenses are handled, and in what order. Super important, right? If you have to make a capital call to your money partner, that needs to be in there, that they get paid before any other distributions to other partners made, if that's how you want it. If I was the money partner, I would certainly want to get my loan back before anyone was getting distributions. It covers voting, meetings, buy-sell agreements, and a whole lot more. Call your attorney. Capital contributions. Capital is contributed to the company by the members, and this determines your percent of ownership. Royce puts in 50% of the money, I put in 50% of the money, we're 50-50. Yes, you can change this, but we're not going to cover that. There's some special rules. So if you put in 40K out of 100, you own 40%. It doesn't have to be money, right? You could put in property or other assets to an LLC, and that counts as your contribution as a part of the percentage. As profits or losses are made, they get distributed almost always according to the percentage of ownership. Again, there are exceptions. We're not going to cover them tonight because they're very complicated, and there's specific rules to the IRS that you would need to know. So 10K profit comes in, and you were this 40K, you'd get $4,000 in the above example. Any questions? No. I got to ask that like James. Any questions? And then just look up here.
Because you got to go fast.
Yep. So structure this deal. $250,000 price, 50K down payment. What is the capital contribution for the money and loan partners? How much is the money partner going to put in? 60K. 60K. Why 60? 50K plus some capital reserves, maybe some initial stuff going on. Agreed. Good job, James. What's the loan partner going to do? They're going to sign on the loan. What's that worth? We're back to this question. What's it worth? Is it worth $200,000? Because that's what they're bringing. But obviously that would make this a 50K and 200K contribution, right? So there's a problem here that the IRS actually may not recognize the value of signing on a loan as worth anything, which is a problem. So there's no substantial economic effect, which is one of these crazy rules. So you have to show this in order to justify different payouts than what's put in. So what's crazy about this is if you do this with the wrong operating agreement, you will have a really rude awakening for your loan partner come tax time. Your CPA will basically say, oh, so it looks like this is the money you put in, and you split the percentages. In this case, it's $60,000 you put in, and you gave 20% of the deal to the loan partner. Your CPA will now say, you got a $12,000 gift, which $12,000 is under the limit, which might be okay, but that's typically not the amount. It's more like, hey, it's a $40,000 gift to him, so now he has to pay income taxes on the $40,000 gift. So call an attorney that's good at structuring these, because there are ways to structure it. There are two main possibilities for this. Loan partner only has a profits interest, so they only get paid after everything else is repaid and they get the profit. Or each member makes really small capital contributions. Royce puts in $200 and I put in $2,000, and we split it that way. And then I make a member loan to the LLC for the rest of it. I'm gonna not even cover this.
Yeah, we have the recording
Yep.
available, so if you guys need to watch it, you can watch the last time we talked.
So the profits interest is just complicated. I wouldn't suggest using it unless you're doing a really big deal with a lot of partners. It doesn't make a lot of sense. It's super complicated. It is very common in larger partner deals, but it's not common in smaller deals for smaller stuff. This is the one I just covered, which is small capital contributions and then a loan for the rest of it. And I've used this. It works really well. In essence, total capital contributions are $3,000, so I would contribute $2,400 to get 80%. Royce, as the loan partner, contributes $600 to get 20%. And that way we don't have this IRS problem of, oh, I gifted him money somehow. And then I basically say, well, I'm going to loan $57,000 to the LLC that has to get paid back first before anything else gets paid out. And that's what that says. So here's some stuff that just didn't fit anywhere else. Own property yourself by utilizing partners. So the gist of this slide is you can go buy a property using partners. You can put buyout clauses in your operating agreement that allow you to exercise a buyout. Royce and I go do a partnership deal. I'm the money partner. He's the loan partner. I can't get a loan right now. He's like, I'll partner with you. And I'm like, great. In 3 years, I'm going to refinance this and I'm going to buy you out. So there's a buyout clause that basically whatever amount I need to have him be like okay with, you know, hey, when I refinance it, I'll pay you $10,000 to get you essentially removed from the deal. And then I can own this deal just myself. Does that make sense?
Is that like a first right of refusal sort of thing? Is that?
It's just a buyout clause. I mean, if it was me and I was trying to do this, I wouldn't give him the option of saying no, right? I would be like, that's my deal pitch. I'm going to come 3 years from now, I'm going to refinance you out, you know, and maybe he's like, that's fine, but if it takes you more than that, I want a penalty, right? So it's a negotiation on that standpoint. So that is how you can own property yourself. Benefits, partnership length is shorter. So we like, well, length of partnership deals. So if you're doing a buy and hold deal and it's 15 to 30 years, how many of you want to partner with me on a 30-year deal? James does. Royce is like, Royce even likes me a lot. And he's like, right? He's like, I don't know where you're going to be in 30 years. And that's the problem. If you're doing lease options and it's a 5 to 7 year deal, how many of you want to partner on that with me? Probably more of you, right? And if I said, oh, it's a 2-year deal, how many of you want to partner? Probably even more, right? The length of time as it grows longer makes you really a lot less likely to want to partner. Buy, fix up, hold, and sell, also a great strategy. I'm not going to cover what that is because you guys already probably know. You learn a lot about partnerships by actually doing them, which is why next week is so valuable because you get to do the negotiation part. But once you've done some partnerships, you learn, I could have done this better. Every time you do one, you're going to learn, I could have done this better. Take advantage of those learnings. Don't just let them go. Write them down. 5 years is a long time. How many of you lived in Fort Collins 5 years ago? How many of you think you'll be here 5 years from now? How many of you lived here 10 years ago? Natives. I'm native too. But, right, if things don't go as planned, how long is 5 years? A long time. Oh, it's this, right? It's misery. It's really miserable. It seriously is. So imagine 10 years. Where were you 10 years ago in life, right? I mean, Royce was not even born. He's like 9. He's turning 10 soon, right? So think about that. 10 years is a lot. You're like, oh yeah, 10 years, I'm going to make $40,000. Yeah, wait. Like, that's a long, long time. Are you getting into a partnership with people that you want to be involved with for 10 or more years? So I talked about this a little earlier. This is the investor point of view versus the deal point of view. So the investor point of view, you go and you present as the investor to somebody that's a friend or family, and you're like, hey, here's this amazing deal. The return's going to be super easy, right? We're going to knock this out of the park. You're going to get 20%. Looks likely that we'll even get more like 30, maybe 35. You're going to be in a great position. And the deal point of view is, here's the expected numbers, and here's the tolerance, right? Here's our worst case when we have, you know, low rents and high vacancy. Here's the best case where we're able to raise rents to what we're hoping. And then here's just the conservative case, right? So when you're presenting deals, I highly encourage you to present this. When you present this, you're putting yourself at risk to either lose your good karma around partnerships and your reputation, and you're putting your partners at risk to lose money. Don't do that, right? And I've been involved in a deal where this was promised and not delivered. And I can tell you I'm super unhappy about it.
Not by me.
Yeah, it's not by anyone in this room. Deal makers, right? Disclose, share, communicate your deal. If you're like, I'm only showing you this part of the spreadsheet, that's a warning sign, right? And if you're going to invest in a deal, be like, I want to see all of the spreadsheet. I want to see all of your analysis. If they're not willing to share it with you, don't do the deal. Capital preservation is your best friend as a deal maker and a partnership creator. If you can preserve other people's capital, they'll be much happier than if you end up losing some of their capital, even if you give them no return. What'd that last one say? Oh, yes. Evaluate the deal, not just the opportunity. Avoid easy mistakes. Protect your assets. Title held by the entity. Get tax, legal, and estate planning advice. All the normal things. Do you have a conflict of interest? James and I's operating agreement specifically states we can still do our own thing, real estate-wise. Because otherwise, that would be weird, right? Put it in writing. Obviously, define what happens if more money is needed, how you get out of the deal, and everything else we've talked about tonight. Comply with all the securities laws, and consider 1031 exchange issues. So if you're going into a partnership and you're planning on 1031ing out, you're going to have the same partners unless you structure the deal on the way in differently. So call an attorney, because that's like a whole class that I could teach on that. Avoid negligence, obviously, because that just totally will make everything not go well. So here's one last exercise for you. Family and friend invest $50K with you. Your pro forma shows you're going to get $30K in profit in 3 years. So basically $10K a year. After 3 years, the property is sold as planned. So that part went well. The end result is a $5,000 loss after doing everything you could to make this deal work. That's $35,000 less than your partner expected, right? This is your mom or your best friend or your dad or whoever you want to imagine, right? What do?
Make them whole.
Make them whole. How do you make them whole?
Cough up to $5,000.
Cough up to $5,000. So you give them their $5,000 back principal-wise.
Yep.
Anyone else?
Probably a little more.
Probably a little more.
So $6,000?
Mow their lawn for a year.
Huh?
Mow their lawn.
Mow their lawn for a year. Yeah, so this is an interesting question, right? So make them whole. So now let's add a couple zeros, right? This isn't a $50K investment, it's a $500K investment, right? Or a $5 million investment. And, now it's not 5K, it's 50 or 500. You're not making them whole. What do? Move to Mexico. That is the incorrect answer. So I think you need to think about this before you do a deal every time. Like, what's going to happen if this doesn't go well?
And have that conversation.
And have this conversation. And I think one of the best things you can do is when this is going on, if it's just like, hey, we did this deal and 3 years went by and I'm like, I'm really sorry, here's $25,000 of your, or $45,000 of your 50 back, and I kind of sneak away, she's pissed, right? Is she ever doing a deal with me again? How about if things start going south in month 6 and I'm like, hey, things are not going to plan. We're currently negative on cash flow. It doesn't look like we're going to make what we thought we were going to make. What do you want to do, right? And we continue to have this conversation on a regular basis, and she's always informed. She knows what's going on. And we get to the end, and it's like, we lost 5K, but we did everything we could. We might have lost 15 if we would have done things differently, but this is where we're at. Is she going to partner with me again? Maybe, right? If those are reasonable things that we did, maybe she will. So I think that's vital. It's really doing that. And here's a whole bunch of other stuff that we could teach an entire another class on, like every line.
Maybe we should actually teach a class on this.
And basically, you need to consider how decisions are made, how disagreements are handled. If it's 50-50, right, it's really difficult. You're ending up in court. How do you decide? Rock, paper, scissors is not a good answer. Who signs contracts? How do you acquire debt? Who does that? How do you pay the bills? Who does that, right? How does money flow? Bills, backup fund, pay back member loans, and then payouts? Those are important things. Who can sign for the bank? What's your exit strategy? Is there more than one? Hopefully there is. Who's covering upfront expenses? So Dealmaker starts going, and they're like, yeah, we're going to do this deal, and they put in $2,000 for an inspection of a small apartment complex, and then the deal falls through. Who pays that? Are they just out $2,000? Or is that the money partner's risk? Like, deal's not done yet. Those are interesting things. I mean, that number could be, on larger complexes, that number could be 6 figures. Who's paying that if the deal falls through? Got 100K in the deal. Who's going to pay for that? Initial backup fund, buyout agreements. Partner stops doing work and wants out of the deal. This is super interesting. James and I partner together. James, 5 years down the road, when we own 30 houses in the partnership, he says, I'm done, and just stops doing his role. Does he still get 50%?
Yes,
what does that
this
look
case.
like? No, you do not. Death, divorce, bankruptcy, and then defining all your terms, obviously, in the operating agreement. But there's just a ton of stuff to consider. So tonight was really, hopefully, geared in getting you thinking about the 3 roles thinking about what they're worth, and then next week is the workshop where we get to actually have a lot of fun in doing that. Any questions? Other than James's, why do you go 12 minutes long? Back in the back.
Question. Wait.
Hang on.
See that question mark next to my number 1 there? You can remove it.
So is it definitely no now?
So after hearing that and hearing the discussion, would anyone change their answer from yes to no, other than the solidified no? Right? And I don't know if you're honestly joking or if you're just like, never will I do a partnership. I mean, if you are partnered with the right people, they're super beneficial. You gain a lot, you gain knowledge, you make a lot of money. So there's definitely great reasons to do them.
Yep. And I'll echo that. And I will say that I think one of the things when you brought up the loan earlier is it's a good reminder that a lot of what we just covered here is, I mean, all of this is fundamental, but when we start looking at percentages next week, that's going to be around single-family rentals, stuff that's taught here, right? And that there are a lot of other deals that are out there, and that your risk exposure may be completely different in different roles. And so it's worth being educated before you jump into some of those.
No further questions? Oh, we do have a question.
No,
He's going to be like,
I
misery.
am the pessimist. I am. I'm sorry. But there are so many roles or so many responsibilities that need to be taken care of. And it just seems to me like you can't foresee any of those. And invariably, one partner starts to feel slighted because he's in there, he's the hustler, he's the one that's making it happen. And this other guy that just signed the papers, he's just, always harping on me. Hey, why isn't that done? Why isn't that? And it goes downhill from there.
This is why you know your partners. Do you have friends that are like that? Or did you get rid of those friends? It's the same thing, right? It's like, who are you hanging out with? Are you hanging out with the guy that every time like you go out and you want to have a drink and he's like, man, you look old and you're getting fatter, and like, I mean, that's what James does to me constantly, and I'm almost done hanging out with him. But would you keep hanging out with that?
The one trio, they went bust in 2006, so I haven't talked to them since.
Yeah, but I mean, if your friends are treating you like that, you find new friends, right? And so I think if you choose to partner with someone who is of that mindset and that attitude, it's going to be rough, right? I'm not sure what that's for.
I don't really do that to you. Just
no, you don't.
Any final questions?
James is trying to get out of here.
No, I don't. I'm not trying to get out of here. One more announcement, and then we'll thank Brian. So reminder, clients that have bought or sold a house with me, I need to get rid of these. I'm not going home with them. So if you bought or sold a house, you know who you are. These are real estate investor courses that you will benefit from. I don't care if you take them and throw them away, but take them. I do not want to take them home. But thank you very much for Brian for teaching the class. We really do appreciate it. And we will see you next week.
Yeah, please come next week. It will be highly entertaining.